The future of money looks smarter than ever. AI manages portfolios, crypto connects global markets, and investors trade with a tap. But here's the question no one likes to ask. What could go wrong? Every decade has its shock. The dot-com bubble, the 2008 financial crisis, the pandemic crash of 2020.
Each one reminded us that progress always comes with risk. And as we look to the next 10 years, economists warn of four major threats: inflation, automation, cybercrime, and climate risk.
Different in nature, but deeply connected. Let's start with inflation, the silent force that eats away at your savings. Even in advanced economies, inflation can rise faster than wages, quietly reducing purchasing power. We've seen it before, in the 1970s oil crisis, when fuel shortages sent prices soaring worldwide. And more recently, after massive stimulus spending during the pandemic, when supply chains broke and demand exploded overnight. When prices rise, people spend less. When people spend less, companies slow down. And when that happens globally, it's not just about groceries or gas, it's about confidence. The invisible trust that keeps markets stable begins to shake. Governments fight back with higher interest rates. Central banks like the Federal Reserve and the European Central Bank raise borrowing costs to cool inflation. But that comes with a price. Loans, mortgages, and business credit become more expensive. Investors retreat from risky assets, and suddenly, both Wall Street and Main Street feel chill. For investors, it's a complex game. Inflation erodes real returns, but higher interest rates can create new opportunities in bonds, commodities, or inflation-protected assets. The challenge is balance, adapting before the wave hits, not after. But inflation isn't the only ghost from the past. History shows that crises often come from where we least expect. In 2008, it was subprime mortgages hidden behind complex derivatives. In 2020, it was a virus that froze global trade overnight. And next time, it could be a chain reaction from climate shocks, cyber attacks, or a sudden AI-driven trading panic. Because money today is no longer just paper and things. It's code, algorithms, and trust in systems we barely understand. The next big crisis might not start on Wall Street. It might start in a server room. So as we move deeper into the digital age, the real risk isn't just losing value, it's losing control. In the next part, we'll explore how automation and artificial intelligence could reshape not just investing, but jobs, inequality, and the very meaning of financial security.
Technology has always promised progress, reshaping our world. For centuries, machines replaced muscle, amplifying human strength. Later, computers revolutionized information, replacing paper with digital precision. Now, algorithms are replacing complex human decisions, fundamentally altering our interaction with technology. Automation isn't new, but the current scale and speed are unprecedented. From warehouses to Wall Street, AI is changing how work is performed and wealth distributed. Self-driving trucks threaten millions of traditional logistics jobs, redefining transportation. AI-powered customer support systems are replacing call centers, offering instant responses. Even white-collar professions like accounting and legal services are reshaped by tireless automation. Efficiency, once a goal, is now a powerful disruptor. Every time a machine takes over a task, it saves money and boosts productivity. But this efficiency raises a profound question: what happens to those left behind? In the short term, automation cuts costs and boosts profits for businesses. However, long term, this could widen the gap between technology owners and workers. Economists call this the productivity paradox. Output rises, but wages stagnate. History shows us this pattern from past industrial transformations. During the Industrial Revolution, new machines displaced thousands of skilled workers. Eventually, new industries emerged, but the transition was painful for many. Today, this cycle repeats, but with accelerated pace and algorithms instead of steam engines. In finance, this shift is especially visible and impactful. Trading floors, once bustling, are now silent, their functions replaced by intricate code. Robo-advisors handle millions of investment portfolios with minimal human oversight. Corporate decisions are increasingly guided by predictive models and data-driven insights. But alongside efficiencies, there's a hidden cost: the loss of human intuition and judgment. AI optimizes for efficiency but lacks ethics, empathy, or human context. It can recommend layoffs based on data, but cannot comprehend the human stories behind statistics. This new wave of automation can reshape our social contract. If productivity soars while jobs disappear, who truly benefits from this progress? Universal basic income, once radical, is now a serious economic debate. Countries like Finland and Canada have tested UBI, exploring decoupling income from labor. Not all change from automation is negative, it also creates new opportunities. New professions are emerging, from AI oversight to machine ethics specialists. Future jobs will focus less on repetitive tasks and more on strategic directing and innovating. The question isn't if automation replaces people, but if society adapts fast enough. The real risk isn't mass unemployment, it's escalating inequality that could fracture societies. Imagine capital working tirelessly, but humans struggling to find their place. When technology outpaces policy, economies can fracture, leading to instability. The middle class shrinks, public trust erodes, and financial instability grows. The future of work may be collaboration, not conflict, between humans and machines. Humans will lead through creativity, strategic thinking, and ethical judgment, things AI cannot replicate. Next, we'll explore risks no algorithm can predict, from cyber attacks to climate shocks. Resilience, not just growth, will define the next era of finance and our collective future. The future of finance is digital and vulnerable. Every transaction flows through invisible networks. These networks can be attacked, manipulated, or shut down by a single line of code. In 2021, a cyber attack on Colonial Pipeline halted fuel delivery, causing markets to tremble. Imagine this happening to a major bank. A frozen payment system could paralyze economies in minutes. Cybersecurity is now finance's foundation. Firms spend billions on AI systems to detect intrusions. The arms race never ends. As algorithms defend, others attack. Money itself has become a weapon. Central banks are racing toward digital currencies, promising efficiency, traceability, and control. But control by whom? A cyber attack or government decision could freeze your wallet or rewrite history. Convenience and surveillance are two sides of the same coin. Climate is finance's silent risk multiplier. Every storm, drought, and wildfire leaves a footprint on the planet and on balance sheets. Insurance firms face record losses. Industries are being repriced by nature itself. When a hurricane wipes out billions, markets learn no algorithm can predict a warming world's chaos. Data keeps growing. AI models integrate satellite imagery and emissions to forecast the unpredictable. It's finance versus physics, and the clock is ticking. Fragility is also about dependency. Our financial system runs on cloud servers and machine learning models controlled by a few companies. If one network or algorithm fails, entire economies could follow. Innovation and collapse are closely linked. There's hope in resilience. Nations are building green finance frameworks and decentralized systems. Blockchain and AI may create a safer, more transparent financial world if used wisely. Finance is built on trust. In the age of AI, that trust may come from code, not people. Can technology make us more secure or just more dependent? The future will answer.